Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today's Thursday. It's August 25th. It's about 8:27. The market's going to open up in about 1 hour and 3 minutes to be exact with you. But I specifically did this video a little later so we could see the GDP and the jobless numbers in real time. Pretty good, right? I figured you might as well get some benefit out of this. We're looking pretty good on the NASDAQ. I mean, look at this, 93 points. Dow. Oh, before I forget, post comments below this video. Let me know if you're getting some value out of them. Send me an email, support@marketgeeks.com. And if you have, I really appreciate it. Thank you for doing that. It really means a lot to me. So let's get into all of this. So NASDAQ 92, Dow 89. The expectations, and they're coming out in a couple of minutes, so we'll go back to this before we finish the report. But as you can see here, we're between 249,000, 270,000 for jobless claims. Honestly, between us here, the number has not been that off. So if we're anywhere remotely close to the 4-week moving average, honestly, even if we're at 268, 270, it's not that bad because the number has not been out of whack. Now this is a big number, and this may in fact impact what the Fed does tomorrow. And I'll get into all of that, but the Fed is meeting tomorrow. And Mr. Jerome, I'm going to wait till I get reappointed Powell to give you my real opinions. Don't get me started on him. We're going to see how this lands, because this can give us, if the GDP, if we're showing on the negative side, and if the market's already pricing this in, and if the number comes up, we may have a strong rally. That may mean that things are looking a little bit better than expected. Remember, GDP is 2/3 retail sales, but retail sales have been on the downside, and I think this negative 0.9 number is baked into the market. So I think anything above and beyond that is going to be positive, and anything below that is going to be negative. It'll be interesting, and I'll come back to it in a few minutes. It should be posted here in just a few minutes. Let's talk a little bit about global economy, and then we'll get into the relative strength charts and all the other good stuff that we do. So, as you can see here, investors are awaiting highly anticipated speech by Mr. You-Know-Who. That's happening tomorrow. Market watchers say share prices are likely to sway for some time. I think they're going to be choppy for quite some time, regardless of whether the focus is on controlling inflation or recession risk, and I agree with that. We're going to see some volatility. In Asia, a wait-and-see mood has set in during recent sessions as market looks for signs from the Fed, and we'll find out tomorrow what they're thinking. I think they're going to remain at 3/4 of a point. I think for like half a second, they thought we were going to go to half, and then for a half a second, they thought they were going to go to 1%. I think they're going to stay at 3/4 of a point, especially because spending has been pretty good, and that was encouraging. But again, you got to let this thing. Go through its course. It's not just going to miraculously get better. We had a problem with COVID, and now we're paying the price. You got to pay the price for your sins. For every action, there's a reaction. All right. Chinese shares have declined this week amid recent policy cuts by People Bank of China, which also announced policies to stimulate the economy. Very different song and dance that they're singing from and playing from a couple of years ago when they were trying desperately to regulate all of their companies. Now they realize they're in a pickle right now. The Bank of Korea has raised its key policy rates by 1/4 points to 2.5 in an effort to fight inflation, even as signs of inflationary pressure appears to be easing. I'm glad to see that they're taking proactive measures. Unlike someone else here that waited 1.5 years, we're not going to mention his name, but we all know who he is. A recent surge in prices of fresh foods remains at risk, according to market analysis. Bank of Korea said the nation's gross domestic product, total value of a nation's product and services, is projected to grow by 2.6% in 2022 and by 2.1% by 2023. I don't know if you guys know this or not, but South Korea is like the global center for plastic surgery. Plastic surgery in South Korea is like state of the art. I can go into why and all that, but my wife has a very close Korean friend. She tells her all this. It's really interesting information. Discouraging reports on the economy have, meanwhile, highlighted the risk of a recession once again. We're going between inflation, recession, and then you have Jerome Powell in between there somewhere. Again, don't get me started. Wall Street's focus remains on Friday when Mr. Jerome Powell gives a speech at his usual economic conference in Wyoming. Beautiful place this time of year. It's been the setting of market-moving speeches in the past, which has investors hoping that he will offer clarity. Yeah, Powell and clarity, never. Here's what I want you guys to focus on. Look at the bond market. Remember I said the bond market has been choppy and it's been holding stocks choppy. Well, the bond market is near the lower end of the range. Now, there's two scenarios. The first scenario is we break lower, and if we do, that increases the chance of higher rates and recession and inflation and all the bad stuff. If we go back higher from this point on, that will decrease that risk, and that'll put us in a wait-and-see mode. And the longer we can stay in the wait-and-see mode, the better it will be for the overall market. So you got to watch this very, very carefully right now because bonds are near 110.77 and the low is like 108.70. So again, the question is going to be whether bonds are going to remain within this channel, because as they went higher in price, the risk of a recession went lower, and stocks rallied. But now they're going lower, and they're taking a lot of the NASDAQ stocks with them. Notice the NASDAQ is not gaining the way it was last couple of weeks. So this is the question right now. And I know I'm oversimplifying it just a little bit, but trust me on this one. This is the best indicator right now of whether we're going to stay in an inflationary environment or increase our chance of having a recession. And if we break this low right here, that increases our odds of going into a recession. Doesn't mean we're going to have a recession, but it increases the risk in the shorter time period. Now, let's see how the numbers are looking. So let's see. We're going a little lower, which suggests that the data may be worse than expected. Let's start with the GDP. Let's see if they've updated it already. Sometimes it takes a few minutes. Let's roll them both and update them while I give you the report. So we'll wait for this to stop because I'm giving it to you literally in real time. So let's see what happens. Let's wait for the numbers. Sometimes when they're updating it in real time, these numbers will continue. So looking and here's here is I'm in the wrong spot. Here's the part that this means they're updating them. See how it's rolling? See how they're just rolling? That means they're updating them in real time. I love when they do that. So a few things. And this is something that I really, really need you to pay attention to as the bond market. Now, notice the bond market is at a very, very crucial point. Well, so are stocks. Let me explain to you why. It's actually really, really important. So remember, as I mentioned to you, that stocks, server error, that means they're updating this thing. Let's keep this going and see what happens. All right, we'll get an answer on that, and if not, then we'll have to wait. But so far, based on the futures, I'm not seeing a very positive result. But let's see what happens. So here's what I want you guys to explain. If you look at the stock market, and this is pretty important, if you look at stocks, you will see that stocks look at bonds, right, and look at stocks. Oops, bonds, stocks. So notice that bonds stayed in this range, right? But stocks got out of this range and now they're back in. So here's what I think. I think if the bond market can continue going a little bit lower, right, and break through this, it's going to put a lot of pressure on the stock market and cause the stock market to start thinking about making new lows. Let's see. Did the jobless number come out? Let's see. Nothing yet. Let's see. It just keeps moving. Oh, here we go. GDP did come out. So, okay, they were looking. Okay, the number didn't come out as bad as they thought, and personal consumption expenditures are actually higher. This is not a bad number. Now, look at this. They were expecting 0.9, right? And they got negative 0.6. It's a little better, not all the way up, but it's a little better. This is encouraging. And personal consumption, 1.5%, and went higher. So this is telling us things. See, this puts us back into the inflation and further away from the recession. Let's look at jobless claims. Let's see if those numbers came out. Let's see here. See, I like doing this in real time. So how's the market reacting? It's okay. It's not really going down too much, but this is encouraging, especially this number right here, personal consumption expenditures. That means people are spending. And again, the GDP is not as bad as it was. So my fear right now is that we're going to go back into this range right here. Let me show you QQQ. This is my biggest fear right now, that we're going to go back into this range, like the bond market is breaking down, so it's going to pull stocks back in here. And if you look at XLY, for example, Notice it's above that range, and if you look at XLK, it's above that range, right? But it's almost there. But when you look at sentiment, when you look at market performance, look at how vulnerable these suckers are. 17% trading above the 200-day moving average. Number of stocks. Infotech, 30%. Communication services, 12%. So these numbers are cooling off. Remember, this was 97%. This was 80%. Now it's 50%. We need these numbers to cool off before the market starts going higher once again. So let's see if oh, here it is. All right, they were expecting to. So the number is not bad. Lower people are applying for unemployment claims. It's not that bad. We're below our moving average. Look, the 4-week moving average, 246. We're at 243. It's not that bad. So that means volatility should actually be, via the VIX, a little lower right now. Or just, yeah, that's okay. I could deal with that. So the numbers are not as bad. It'll be very interesting to see what the Fed says. As you can see here, the bond market is kind of flat, not really doing anything pre-open. But these numbers are encouraging, and these numbers are telling us we're not really in as bad of a position as we thought, especially with the personal consumption being at 1.5. Now, good. I'm glad to see that. It means we have a chance. Let's see what Powell says tomorrow. So as far as sectors are concerned, as far as individual sectors, cumulatively, energy utilities on a monthly basis, energy utilities. Notice consumer discretionary. Let's go back 1 week. Look at consumer discretionary last week. First spot, right? Look at technology, third spot. Look at it now. Consumer discretionary, technology, a lot lower. I'm expecting these to continue going lower and energy utilities and consumer staples to start coming up again. Matter of fact, cumulatively speaking, consumer staples is already coming up. I think consumer discretionary and technology are going to start coming back down, and you're going to see healthcare and consumer staples starting to come up. We're going to see more of a defensive market environment. I don't think consumer discretionary and technology can hold up their strength too much right now. Also, keep your eye on ARK. Let me show you something. That Cathie Woods, the small caps are very sensitive to interest rates. Now, remember I showed you the bond market? Look at that, and look at that. So be careful, because if the bond market breaks down, it'll have a major impact on Cathie Woods stocks as well. A major impact on those small caps. So when the economy starts cooling off, when we have more chance of recession, inflation, you're going to have to be careful with small caps and tech stocks because they have the biggest exposure. Now, sectors. I'm still liking energy, folks. I'm liking energy, and my top ETF, and I've been saying this now for a few weeks, it remains the energy sector. We just broke out of energies. Let me show you this here. We just broke out of energies. We're going higher, and I think there's a good chance we're going to meet the highs again. So I like that, and I like the consumer staples. Let me show you the consumer staples. So consumer staples looks like it's pulling back. I think consumer staples is going to rally, and I'm bullish once again on consumer staples. Matter of fact, I like this sector a lot right now. I may actually put it in one of our programs now that I think about it. We have a nice little pullback. I would go all the way to December. It's at 76 right now. The options are not expensive. There's some pretty good liquidity right now. Look at the open interest. It's good. I would wait for the market to open. These things are going to tighten up as the market opens up. Start at the bid and limit order your way up to the offer. I would go for probably the 77s or the 78s, or I would buy the 77s and probably sell the, let's see here. Buy the 77s for around 235-ish. That's the last price paid. And I would probably sell the 81s. Or just, honestly, they're so cheap. They're like less than $4. Just buy the 76 or 77 and be done with it. It's better. You don't need a spread. And implied volatility is not crazy right now. I like the consumer staples. And I think consumer staples have another chance to run up to the 77, 80 area. I think we're going to see that in the near term. Again, the market right now, if we look at the futures, let's see if they're really selling off. Because honestly, the numbers are not that bad. Let's take a look here. Here we go. Yeah, now they're not that bad. They're okay. They're falling off a little bit, but they're not that bad. Earnings. You've got Peloton today. They reported already the numbers were awful. But then you've got Abercrombie. You've got Dell, Dollar General. I'm very anxious to see how these companies do right here, Dollar General and Dollar Tree. You've got Gap, a lot of retailers. And retailers are not doing that great, but they're holding on to their own. Folks, be very, very careful. We're going to enter a choppy period, and I think defensive stocks and sectors are going to start leading again. I don't like what I'm seeing with the bond market. This right here has been dictating stocks for a while, and this puts more pressure on stocks, and I'm seeing speculative stocks starting to rally again. So either go with the energy ETF or the consumer staples ETF or the utilities ETF. I think utilities may be a little overdone right now. Now, before I let you go, I've got something good for you, something important. And please post those comments and feedback. I don't get peanuts for this. I want to make sure you guys are getting value out of this. Have you ever noticed after a stock crashes like 20% or even more, that's when big banks often come out and publicly downgrade it? I've seen this happen time and time again. It's interesting, right? After the stock is already down, that's when the stock gets downgraded. Now, if you're thinking that sounds a little squirrely or a little fishy, then you're like Jeff Zananeri. So Jeff started digging. He's very analytical. And what he found was extremely interesting. He just revealed all the details of what he found and how he's using it in his trading. And you guys are going to love it. When Jeff told me he was doing this, I said, Jeff, I'm jealous. I wish I came up with this. It's smart, it's simple, it's effective, it's punchy, and it makes perfect sense. You got to check it out. Access his workshop, get all the details, click the link below. If you're watching on YouTube, you could get it the link in the descriptor. Follow now. You got to check this out. It's really, really great. I told Jeff, this is wonderful. I'm really proud that you're part of Wealth Press and you're bringing this to the Wealth Press community. Follow the link below. Jeff is red hot, and his trades have been really hot too lately. I'll see you guys later. Have a great, great day. Bye, guys.